Welcome back to Analyst Bytes. Many students feel like they understand intercorporate investments, but then get confused when comparing the equity and acquisition methods. The biggest question is, why do both methods result in the exact same net income and equity? The logic trap is a favorite topic for the CFA Level II exam and a very common place to lose points. Today, I won't just repeat the textbook. For the next 20 minutes, we will dive into a real case study. We will remove the noise of Goodwill to show you the pure logic behind these two methods. Once you understand this, you will master the fundamental logic of this challenging chapter. Follow my lead and let's start. In this lesson, we will do the opposite and start with the conclusion. Look at the screen. In the battle between the equity method and the acquisition method, remember this, the bottom line is the same, but the scale is different. The results stay the same. No matter which method you use, the final net income and the equity belonging to the parent are exactly the same. This is where exams often hide trick questions. The scale changes because the acquisition method uses line-by-line consolidation. Your total assets and total liabilities will be much larger than under the one-line equity method. To put it simply, the equity method treats the subsidiary as one whole apple, while the acquisition method cuts that apple into pieces and mixes them into every line of the parent's report. Numbers don't lie. Next, I will use a case with 7 core points to show you step by step how we get to this result. Let's look at the case first. There is a very classic time trap here that is often ignored. On July 1st, 2025, Analyst buys paid $600 million in cash for 50% of TechCo. Please pay attention to this date. The acquisition happened in the middle of the year. The two sets of data on screen are our tools for this case. The balance sheet. This shows the financial position of both companies at the exact moment before that deal. The income statement. Pay attention, the parent provides a full year report, but the subsidiary, TechCo, only provides a report for the second half of the year. Why do we emphasize the second half? Because as an analyst, you must have the instinct that the parent only has a claim on earnings after the closing. TechCo's profit from the first half of the year has nothing to do with the parent. Only the results after July 1st can be included in the consolidated report. Remember this timeline, it is the logical starting point for our calculations. Now let's do the first question. Based on the purchase price and the fair value of TechCo's assets, does this transaction result in any goodwill? Think of the target company as a cake made of 3 components. First, the book value. This is the most basic layer, simply total assets minus total liabilities on the balance sheet. Second, fair value adjustment. This is the difference between an asset or a liability's market value and its book value. In the CFA exam, you will mostly see this in fixed assets and inventory. Third, goodwill. This is the premium at the very top. It is the excess price the parent pays over its share of the first 2 layers. Conceptually, goodwill represents the parent's vision or expectations for the subsidiary's future success, such as brand power, management expertise, or expected synergies. Now let's do the math. First, check cost book value is 1,000 million. It is total assets minus total liabilities. Next, the fair value adjustment. Only the fixed assets are worth more than their book value. 700 million versus 500 million, giving us an adjustment of 200 million. And we know the total purchase price is 600 million. Finally, the goodwill calculation, and here is the key. Since Analyst only bought 50% share, we must multiply the sum of the two parts by 50% before comparing it to our purchase price. So the result is exactly 0. In this case, we removed goodwill by design so you can see the most fundamental differences between the two methods without any extra accounting noise. The first question is done. Next, let's look at question 2. There are two core questions here. How does the parent's single financial report change under the equity method? And does it even have a consolidated report? This brings us to one of the most important concepts in Level 2, one-line consolidation. Think of one line as taking those 3 layers of the cake we just analyzed and packaging them into a single account on the parent balance sheet called investment. We no longer show them separately. Look at the accounting treatment below. Analyst paid 600 million in cash, so assets decrease. At the same time, we add a new asset called investment for 600 million. One asset goes up, one goes down. The T account stays balanced. Please look at the report on the right. You can pause the video to compare. At the exact moment of the purchase, the parent's total assets, total liabilities, and equity haven't changed at all compared to before the deal. To answer the last question, because the equity method doesn't involve adding the subsidiaries' assets and liabilities line by line, there is no separate consolidated report. The parent's single report is the final result. Question 2 solved. Now that we've seen the one-line approach, let's jump straight into the acquisition method. This side-by-side comparison is the only way to truly understand why the methods lead to the same result despite different steps. First, a quick reminder on the parent's separate financial statements, the initial recording is identical. Cash decreases by 600 million, and a new investment asset is added for 600 million. The real split happens during the consolidation process. In the acquisition method, we create a consolidated balance sheet for the entire group. Here is how it works for a group perspective. Step 1. Cash decreased by 600 million to pay for the deal. Step 2. This is the key. We bring in 100% of the subsidiaries' assets and liabilities at fair value. Many students get stuck here. Why add 100% if we only bought 50%? Will the table still balance? Look at the T account on the screen. Check cost. Total net assets at fair value are 1,200 million. Think of this as a package. On the asset side, we removed 600 million in cash but brought in a 1,200 million package. Suddenly, the left side is up by 600 million. To balance this, on the equity side, we must record 600 million of non-controlling interest. This 600 million represents the 50% share that belongs to the minority shareholders. From the group's perspective, they are also owners. Without this NCI entry, the balance sheet will never balance. If you try to add the subsidiaries' equity instead, you will be stuck forever. Look at the final result. The consolidated assets and liabilities have expanded, but the common stock and the retained earnings belonging to the parent stayed at the same, rock solid. So please remember these words. 100% net assets in, cash for ownership percent out. The rest is NCI. And let me give you a quick pro tip. In real accounting, we must eliminate the investment account first. This avoids counting the same asset twice. Just keep this concept in mind for now. Alright, the hardest part is over. Stay with me, the logic is about to become crystal clear. Next, question 4. After the acquisition, does TEPCO see an increase in its cash balance? Where did the 600 million paid by the parent actually go? So let me ask you a question. Why didn't the subsidiaries' cash increase after we paid 600 million? Look at the picture. The logic is simple. The 600 million from the parent didn't go into the subsidiaries' drawer. So where did the money go? Look at the red magnet. That money went directly to the old shareholders. It's a deal between owners. The parent gives cash and the old shareholders give up their stock. The money stays between people. It never enters the company itself. This is why the subsidiaries' cash doesn't change. Remember, the shareholders are not the company. If you understand this boundary, you will never get confused again. Now the focus shifts from the balance sheet to the income statement. First, a quick question. Do we need to consolidate the subsidiaries' profit from the first half of the year? No, since we bought the share on July 1st. Anything the subsidiary earned before that date has nothing to do with us. Now question 5. How do we calculate the profit under the equity method? Here is a core point. Fair value amortization. Look at the numbers. The fair value of the subsidiary's equipment is 200 million higher than its book value. You should know this. The subsidiary calculates depreciation based on its original 500 million book value, but we bought it at the 700 million fair value. So the parent must record the extra depreciation on that difference. Now let's calculate it step by step. That 200 million spread over 10 years is 20 million per year. But wait, we only owed the company for half a year, so we only record 10 million in extra depreciation. Now the final math. Take the subsidiary's reported net income of 100 million. Subtract our 10 million adjustment to get a corrected net income of 90 million. Since we owe 50%, our share of the profit is 45 million. One last reminder. Do dividends change this 45 million profit? Not at all. Profit is a fruit grown before the dividend. Dividends are just cashing out your investment. Cash goes up, investment goes down. It's just an exchange of assets and doesn't affect the income statement. Question 5. Perfect finish. Now that we've finished the equity method, let's look at the acquisition method. Same question. Look at the left side. Since this is a line-by-line consolidation, the income statement works the same way. We must add 100% of the subsidiaries' revenue and expenses for the second half of the year. And of course, don't forget to subtract that 10 million depreciation adjustment we just calculated. This creates an interesting result. On the parent's income statement, it looks like we are adding the subsidiaries' entire 90 million net profit. Is this more than the equity method? Not so fast. Look at here. We must use a key adjustment called net income attributable to non-controlling interests, also known as net income-NCI. Even though the numbers on the report look large, remember that only 50% of the subsidiary's profit truly belongs to the parent. The other 45 million belongs to the other small shareholders, and the parent company cannot take it. So after we subtract this net income-NCI at the bottom, the net income belonging to the parent is still 45 million. Did you know this? After all those steps, the final net income is exactly the same as the equity method. This is the same result we wanted to prove. Problem solved. One last variation. What if the parent issued new common shares instead of paying cash? Don't panic. If you are confused, just break the process into two simple steps. Step 1. Imagine the parent company issues 600 million worth of new stock to the public for cash. On the balance sheet, cash goes up, and common stock also increases by 600 million. Everything balances. Step 2. The parent then uses that 600 million in cash to buy the subsidiaries' shares. From here, the consolidation process is exactly the same as what we just discussed. So where is the difference in the final report? Look at here. Compared to a cash deal, this method saves 600 million in cash, but the price is that the parent's all common stock becomes much larger. This led to a very hidden exam point. The parent company's total assets and total equity have both increased. This means when you calculate ROE, the denominator, equity, is now much bigger, which will drag down the final ROE. Other than that, the accounting logic remains unchanged. No matter how the question changes, if you can break down the flow like this, you will solve it with ease. Seventh question, mission accomplished. Okay, to wrap up, let's condense everything into a few core principles. If you ever feel lost while doing practice problem, remember the words in pink on the screen. Accounting rules do not allow a company to create fake profit or equity just by switching methods. Therefore, no matter the method, the final net income and equity attributable to the parent must be identical. Here is a quick review of the other key points. At the parent separate level, the deal is just a reclassification of assets. Cash goes down and investment goes up. No new assets are created out of thin air. For equity method, remember the one-line rule. The investment account is a three-in-one package that already includes the book value, the fair value adjustment, and any potential goodwill. acquisition method. Under line-by-line consolidation, assets and liabilities will expand. But remember, never add the subsidiary's equity to the parent equity. Without goodwill, the difference is balanced by NCI account. For income statement, use net income attributable to NCI to remove the portion of profit that doesn't belong to the parent. Also remember that fair value amortization adjusts the subsidiary's profit before it hits our bottom line. Finally, dividends are just a way to cash out and do not lower the consolidated profit. Congratulations! You have successfully passed the challenge. Through the 7 core questions in this case, we have fully broken down the fundamental logic of intercorporate investments. If you have mastered these basics, you can already handle 70% of the questions in this chapter. Of course, to show you the pure logic, I removed the impact of goodwill today. So in the next video, I will bring goodwill back. I will use more real case examples to explain the differences between full goodwill and partial goodwill, and how they change the size of NCI. Also, I will dive into another tricky topic, the internal transactions between parent and subsidiary companies. We will cover both upstream and downstream transactions to clear those common exam traps. Subscribe now so you don't miss our deep dive into goodwill, the next piece of the puzzle. I'm Analyst Bytes. Every problem we solve is a step toward passing your exam, and every case we analyze is a window into the real business world. Let's take CFA out of the pages and into your life. Thanks for watching, and I will see you in the next one. Bye!